So what I'm going to speak about today is a recent synthesis that we put together. This is with Josh Blumenstock and David Sung-Ho Park, who's a graduate student at UC Santa Cruz, finishing up and going to the KDI school in, thank you, in Korea. And this is a synthesis of evidence collected from the first round of Digital Credit Observatory projects and was written up a few months ago. Okay, so just to give a broad overview of what the Digital Credit Observatory is all about is that there has been an explosion of digital credit products in the past 5 to 10 years. And I'll have some statistics on the next slide about the scope of these projects or these products. So these have been, rather than being necessarily a different form of credit that's already existing, many people view this as a completely revolutionary change in digital access to credit. And a term that's often used is that digital credit is instant, automated, and remote in the sense that loans can be obtained immediately off of a cell phone or some other device. There's no interaction with a human, and loan decisions are made by algorithm, and that they can be made at any distance. So it's a dramatic change in a dramatic reduction in transaction costs and in potentially in access. And so these loans, the basic question motivating the DCO was to study the reality that these loans have exploded in popularity across the world and to look at the impact of this change that is occurring. Okay, so this is just a figure to get a sense of what digital credit is all about, which is just that we're going from a situation in which loans might be approved, loan applications have to be put together and scrutinized by a loan officer, and that might take days or weeks, and that can be now done in seconds, where people can potentially be applying for and receiving a loan in just a matter of a few seconds. There's no human interaction whatsoever, and critically for this space and for a large academic literature in many parts of economics and other disciplines, it reduces the costs of reaching a bank or a financial institution dramatically. So making transaction costs fall dramatically. Okay, so the Digital Credit Observatory was about studying these different types of loan products. And so we funded a series of different evaluations, and one critical issue about digital credit is that there are different forms of digital credit that have very different characteristics in different countries. So one of the main focuses for those who are doing development economics or people who have worked in financial inclusion in places like Africa, and there's several such people here today, is in Africa, the dominant form that's been talked about and studied the most is about bank and telco partnerships. So these are relationships where the loans are being dispersed on mobile money networks, which have proliferated, and there's been extensive study of the effect of mobile money on the financial lives of individuals. And so banks are backing loans that are dispersed on those digital networks. They're paid back on those digital networks. A lot of consumers would perceive these products as being provided by the telco itself, even though they're actually backed by a financial institution. And some of the most famous, for those familiar with this, some of the most famous products are in this area, like M-Shwari being the prototypical example in Kenya. That's only one form, though, even though it's probably been the dominant form of the nascent literature in this area. Okay, a second form is one that are bank and fintech partnerships, okay, which do not include have nothing to do with the telco system, which is really a specific institution that exists in Africa primarily. Okay, and so this is also proliferated. This has been not as much of a focus necessarily for the Digital Credit Observatory, but is an interesting and important area to look at. This is a dominant form of finance, especially in Asia. There's also non-bank fintech, which often take the form of smartphone apps that are directly financed with no bank intermediation. And we have at least one study that looks at that type of institution. And then finally, probably the most dominant or the largest form of credit generally is airtime loans, which people are applying for loans where they get airtime in advance, which they then pay back. Those have proliferated throughout the world. Okay, so there's a huge variety of different types of products. The DCO up till now has only scratched the surface on a few of these, but it's important to realize that there's a vast literature that needs to be created to look at details of all of these. Okay, so just to give a sense of what some of these products look like, just to get just a basic idea. So if we look at some of these bank telco partnerships, MNO partnerships, typically the loan sizes are extremely small. I've participated in a study in which the loan sizes were even smaller than this, but if we take Mshwari as the main example, the loan sizes grow to some extent, but many of the loans are for $10 or less, especially as people are starting out. The scope of these, what the DCO is like primarily focused on is just the fact that the number of people who are applying for these loans is an enormous amount. So in Kenya, there's an estimated 4 million monthly active users, and there's 17 million total loans made in 2020. So this dwarfs the size of the traditional loan market in that country. Okay, the other motivating factor of the DCO is that just the cost of these loans seems extremely high just in a vacuum. So because these are dispersed on mobile money, these are framed not as interest rates, but as facilitation fees. And so Mshwari features a fee of 7.5% per month. Okay, in the a study we had done in Malawi, the interest rate is something like 10% for every 2 weeks. And so when you calculate the APR on these loans, they're well over 100% APR, sometimes much higher than that. Okay, and so one of the questions is it possible that these loans are harmful to people in the sense that they're taking out very high interest rate loans? And it is similar to a tradition in economics studying the effect of high interest rate loans like payday lenders. On the one hand, if revealed preference argument in economics is that if people are taking them out, then they must be benefiting in some way, or they must demand them in some way against an alternative, which is primarily based on people not being informed about exactly what the terms are, what the consequences are for non-payment. When we look at some of these, I won't spend as much time speaking about the other types, but the bank fintech partnerships, those tend to be in more developed credit markets at this point where the loan sizes are much larger and the interest rates are lower. So that's something that would be an interesting next step, perhaps, is to look at a lot of the DCO research is really about nascent products that are they're still being tried out where these have reached a higher scale. Okay, and then finally we have non-bank fintech products, and so these feature more heterogeneous interest rates. But generally also include rates that are very high. Okay, so that's so the basic question is, like, do these products help or harm borrowers? And I guess it's kind of this contrast is a bit of a straw man, because it's probably almost certainly the case that some people are like, clearly some people are going to benefit from having access to liquidity in times when they really need it. On the other hand, it also seems very likely that certain people are going to be harmed by having such easy access. So the great thing about digital credit is that it's so easy to get it, but the bad thing about it is that it's also so easy to get it. So it's almost certainly heterogeneous what these effects are going to be. Okay, but I would say that probably one of the big questions is just in terms of the harm side, is that there's a lot of evidence that people really don't know the terms. They're not fully informed about what they're doing, and default is common. So the question is, what are the consequences of default, and what are the consequences of paying back late? Okay, so we can just give a brief, in the limited time we have here, I can just give a brief overview of what we have in our digital DCO portfolio so far. We had 8 studies that were completed. So one of the issues academically about trying to do these sorts of impact evaluations is that these products are new, they're risky, They involve real sums of money by lenders, and it was not uncommon for the products to fall apart or for repayment difficulties to make a study unviable. So there's 8 studies in 6 countries, which are mostly, a lot of them are in Africa. There are some, and then there's 2 exceptions, one in Haiti and one in Mexico. And in general, just a starting point is that most of these loans are of the type that we're talking about, very short-term, high interest rate loans offered directly to consumers. Okay, the customer base for these is important to keep in mind are typically, in general, people will have to have a cell phone, they'll have to have mobile money usage history. They tend to be much better off than the average individual in these countries. Okay, so we have a couple of different types of products, and so we have some that are bank MNO partnerships. Okay, and so there are three studies. There's a lot of information here, but just probably the most important one is to look at panel B, where we look at the fees and the interest rate. So Mshwari, the first column, which is studied by Suri et al., is a 7.5% per month. Okay. The Brailovskaya et al., which is a study I was involved in, is actually 10% for 15 days with compounding interest and sizable fees. And then the third study is one with mobile money agents that features a much lower APR because it's targeting the intermediaries that are actually selling airtime loans to individuals. Okay, but in general, these have very high interest rates. You should see from the second and the third column, if you look at the customer base, they differ quite a bit in how established they are. So the study in column 2 is just this is a rollout of a new product compared to the much more developed study in the much more developed credit market in Kenya. Okay, we have studies of airtime loans, and the point about these is just when you look at the fees, the key number again, this is one in Haiti and one in Rwanda, that the fees are also extremely high. So these are loans that can only be, you're taking out a loan, which is just essentially just getting advanced airtime, which you then, I think the default on these is very low because it's just immediately paid back when you next add to the phone. But yet the interest rates are very high in a vacuum. And then finally, when we look at these non-bank fintech products, these, it's a very similar pattern. So a smartphone app in Nigeria, has, I'm not sure if I think that might be 1.5 to 20%, but in any case, there's interest rates are vary, but then the high end are quite large. And then a study in Mexico, which will be talked about later, offers also what appears to be an incredibly high interest rate. Okay. So what these studies, maybe I'll skip these. What these studies, what that slide was just showing is that these studies offer, use different approaches to look at these. Some are RCTs, others are using data provided by the telco company directly. But if we look at, who are the borrowers, it turns out that that if we were to look at numbers such as average years of education, okay, if we look at, say, the one I know best, which is column 2, which is Brailovskaya et al. in Malawi. In another study we've done with rural populations, the average years of education might be 4 or 5 years, but the customer base for these products is really more affluent, more urban individuals who you would think in a vacuum would have better access to credit in the first place, but they tend to be younger, they're more urban, they're better off, and yet there's quite a demand for these loans even at these interest rates. Okay, and that seems to be true across a lot of these different studies where just in general, the borrowers are very positively selected in terms of income. Okay, and if we were to look at, a key number is just, first of all, like how popular are these loans in the first place? Okay, so in this table, the key number here is to look at the take-up rate. What percentage of people in the studies that we were able to look at, there's a population that was eligible for loans, and then researchers were able to look at what percentage of people that were eligible were to take out a loan over different time periods. And so in Kenya, in column 1, 34% of people who were eligible took out a loan over that time period, which seems like a quite sizable number. So this just gives some context as to, we know that these loans are popular because there are millions that have been taken out, but gives us a experimental sense of what percentage of people are interested in loans even at these high interest rates. In our study in Malawi, it was 35%. Okay. Moving to columns 4 and 5, for example, where we look at these airtime loans, which again are getting advanced money for airtime at a 10% interest rate, the take-up rate is 45% in one country and 70% in the other. Okay, and then so forth and so on. So just a general pattern is that people seem to be interested in taking out these loans despite these very high interest rates. Okay, which could be a cause for concern if you believe that these loans could be harmful. On the other hand, from an economics 101 perspective, would suggest that people value these loans, and we would then want to look at, what are the actual costs and benefits for the individual, including what is really the effect of default. The total value of loans tends to be low, as I've talked about, and then we look at the default rate. This varies quite a bit across these different contexts, but it's not zero, but it's also not extremely high. Necessarily. So this varies from one context to another. One reason, of course, why the interest rates are as high as they are is because default is happening. So in my particular study in Malawi, we had a default rate that was quite sizable. About 15% of people were defaulting on loans. Okay, so what do we know about, we're first going to talk just about a couple of impacts that we know so far. Okay, first of all, what do people know about the loans that they're taking out? Okay, and so these studies are interesting in that they're different in terms of their approaches. Like one is using existing administrative data, others are using surveys. In the study in Malawi, part of it was a randomized controlled trial of informing people of the terms and what exactly they were signing up for. And it turns out, maybe not shockingly, that people have very limited information about what they're signing up for. So it's hard to even measure exactly what they know, but it's something like a third are even aware that there even is a due date or that there even are late fees. And so that could be concerning. In the RCT, however, when we inform them of the fact that there are late fees and the interest rate is what it is, people actually like the product more, not less, which was completely contrary to what we expected. But upon further exploration, seems consistent with the fact that the credit options that people have are very limited. And so despite these rates that seem high in a developed country context, these are reasonable terms and from their point of view. Okay. This information intervention actually reduced default, however, as well, which is an interesting fact that suggesting that financial literacy could be beneficial for the lender as well as for the borrower. So in one of the later talks, Sylvia Prina will discuss more about her study, which shows some interesting results about the waiting time for loans and whether that improves repayment. Okay, and so one of the big questions remaining from this first set of studies is like, well, what is the effect? Like just taking aside any sort of theoretical question, just like, does digital credit work or does it hurt people? And I would say that overall, we're plagued by the fact that on the one hand, we only have a couple of studies and the sample sizes are not incredibly huge. Okay, so we don't necessarily have a definitive answer, but of the 3 studies that do exist, one study shows some positive effects on outcomes like risk coping, and then some limited effects on other outcomes. I would summarize that as suggesting that there's some modest evidence in favor of digital credit being beneficial. In our study in Malawi, we find very limited effects on most outcomes. We find a modest effect on financial security, but no evidence of any real negative effects. And then in Josh Blumenstock and his co-authors' work, they also find some positive effects on some outcomes and more modest effects on others. So there really hasn't been that smoking gun evidence of real serious harm to individuals, which is consistent with the prior work about payday lenders and that sort of work. Okay, so this is really very much an open question though, because it just hasn't been, we just have a couple of studies. Despite all despite several years of work on the question, it's not so easy to find a product and to evaluate it. Okay, so we, as I said, we have modest welfare impacts, but on the other hand, we also know that there seems to be overwhelming evidence that people are poorly informed. So the open questions then that we would leave you with are, first of all, I think there's a pretty clear case for consumer protection and interventions to target knowledge. As I said, the one study that actually did a randomized controlled trial about this found the paradoxical effect that people were more likely to take out a loan, but they were less likely to default in the short term. That's an open area, certainly. A second issue that I've kind of skipped over is just that the products that exist are really not ones that are going to solve the biggest problems facing rural communities or just people in need in any sort, because most of the products are really just short-term, high-interest rate consumer loans, and those could be beneficial for coping with a small shock or with dealing with things of that nature. But they're really not at all designed to spur productive investment or to invest in education or so forth. So one promising area is work by Paul Gertler and others to look at the effect of digital collateral for productive investments like things like solar panels. And there's because there's a clear benefit to the household over time. And then work as well on terms of improving the credit scoring models directly. So that's something that the DCO was interested in doing, and projects are still kind of results are still coming in, but improving those credit scoring models to target gender, to target need, those are open, important questions. Okay, and then finally, as I talked about at the beginning, we know that there's going to be some positive benefits and other negative. It would be nice to be able to design bigger studies which could look at those positive and negative effects. Okay, so I'll skip over the DCO 2.0, which is basically just restating what I said, which is that we're trying to answer those bigger questions. And with that, I'll leave it to Josh to talk about the data privacy. Thank you. Oh yeah, I don't know. Dan, are we doing questions now or? Okay.
Has anyone looked at this from the perspective of the banks themselves? In other words, might these loans be subsidizing other important activities that the bank is doing? How profitable actually are these loans with the whatever losses that may be involved in doing the work? And why wouldn't there be more competition of other, if these are wildly profitable? Why wouldn't other people be jumping in to perform these loans?
Yeah, that's a wonderful question. So many of these studies get some sense of, well, at least some are able to say something about what the return for a loan is, just in terms of the default rate and the repayment and so forth. But for the especially for these bank telco partnerships, they're also provided, like, so a lot of the money is being used to buy airtime or to use mobile money networks, which generate other fees in terms of transaction costs and things like that. So in terms of fully documenting those costs, it's been hard to do so far. Like, we can look at the direct financial return to a marginal loan, which looks like it's barely profitable. And we also know from from our experiences that a lot of these projects didn't exist. They went away after some amount of time, suggesting that there are like liquidity issues with them. So I think one of the main ways is just looking at the scope of how big these products get over time. But a definitive answer to your question, I don't think exists as of yet. Because as you said, there's like complementarities across these different products especially that the telco is offering. But yeah, Enrique.
Thank you, John. Thank you for the presentation. Very, very useful. I had 3 quick questions, John. when you mentioned take up, was that share of people that was only demand or was supply? Only, you said 35% take up of those offered loan, right?
Yeah, those eligible for loans. Yeah, so it's the demand for the loans.
Okay.
Yeah.
Do you know what are the rejection rates for the applicants? How many passes they scored?
Yeah, so like many of these are designed, like the vast majority of these are designed around, like I said, credit scoring threshold where they've already pre-qualified for a loan. So I don't think we really have any studies that were the studies were not really around the algorithm itself or like how that was set up per se, but is really more about conditional on being above a threshold where you qualify. So most of these are based on like there's a score and above that score you're eligible.
So it's like pre-approved people on
yeah, essentially.
Okay.
Yeah.
And the last quick question was, you talk about the effects of credit, and I know, I mean, you know, there's been dozens of studies of microcredit.
Yeah.
Why is this different? Is the population that different?
Well, it's an interesting question. I mean, it's like really like the heart of the question in some sense, like, is it really different or not? So I think that it's different in the sense that like potentially like in theory, digital credit could reach a whole bunch of people that aren't reached already, or the types of people that are willing to take out these loans that can't access, it's harder to access like a bank or whatever, could be different. But from a certain point of view, maybe it's not so different than that existing work. I'd say the one thing that's different is just like surely like just the sheer number of people that are taking out these loans is so dwarfs that like I think in Kenya it's something like, I mean, isn't there a number that's like 10? There's 10 digital loans to every traditional loan at this moment in time. So but I think your point is spot on.
Question in the chat from Genevieve Smith. Can you share more about the types of tools that use AI and machine learning to assess credit worthiness? Are these using alternative data on smartphones to offer different size loans to different folks or different interest rates? And if so, do any studies explore potential biases these AI tools have? I guess you can start to answer and then pass it off to our next speakers.
Yeah, so Josh has kindly volunteered to take this.
Okay. There's one more that you might want to answer, John, which is from Rowena Cornelius. What is the time frame used to define the default status since these are short-term loans?
Yeah, exactly. So the default, I mean, so there's I think it's the case that after like some period of time, people really don't repay. So it's just over like several months, but it's in the data that I know best, it's very uncommon or unheard of to be paying back after like several cycles have passed.
And then we'll take one more here in the room and then we'll turn over to Josh.
Great, thank you. You asked sort of rhetorically, you know, what are the consequences for people for default or repayment? And I'm curious if you're really looking at that in any of these studies. Sort of what are those consequences? Anecdotally, I've sort of seen in some cases the consequences for these digital loans are lower than consequences faced for defaulting on something like a Village Savings and Loan kind of group loan. So I'm just really curious if you guys are looking at that in any of these studies.
Yeah, it's like a controversial question in a way, because because taking the example I know the best, which is in Malawi, there's no functioning credit bureau really, as far as I'm aware, and there's no other, they're not applying for mortgages or other sorts of credit in the first place. So I think that honestly, the consequences are pretty modest, but that's a controversial thing to say. And then on top of which, in other, like there are stats like in the earlier years that, millions of people have been reported to the credit bureau in Kenya for non-repayment of $10 loans. And so the question of like, how much does that even matter for people that don't have access is a very interesting question, but it's fraught to even discuss that sort of thing. So they are, like in a narrow sense, one could look at it as you're getting this free money and there's no consequences whatsoever. And so then the question then is, why are they repaying at all? And so it's an interesting question. And I think that in some sense, the studies really only make sense to really study if they're functioning in some way, because I think the countries differ dramatically in terms of what the consequences are. And that would be, so I think it's something we are very seriously like thinking about, but it's just that because there's only like 3 countries that have been talked about so far, that it's just a very hard question to answer. But once you start getting into these issues that it's like okay for people to default, and it's just like there's a lot of pushback from some observers that you know, it's hard to like definitively say that you've really considered every possible cost and like what's going to happen 5 years from now when the credit market is more developed than it is and so forth. But I think it's a very well taken point. Thank you.